before, because he worked with another syndication group where I've invested in, and the last 6 or 8 months I've heard him on some podcasts, and I realized that he moved over to Ashcroft Capital. That he's been on the podcast circuit. I kind of Googled him, and it looked like you're on at least 24 podcasts as a guest, which is amazing. So that's great. That's a lot of talking.
Count. Yeah.
Yeah, he's been on the Apartment Building Investing podcast with Michael Blanc, the Real Wealth Show with Kathy Fetke, of course, Joe Fairless's podcast, their best real estate advice ever, and the Jake and Gino podcast, so among others. And as far as I can tell, it looks like you've invested in at least 25 passive syndications through about 14 different sponsors. So you're definitely going to be a wealth of knowledge for us here, and you're very passionate on the podcast about teaching about real estate investing passively. So that's what our group is all about. And so thanks for taking the time to speak to our group, and we'll go ahead and let you have the floor so you can get going.
All right, you bet. Let's try to do a screen share here real quick. I think I can do that. Let's see here. All right, can everyone see that screen?
Yes, sir.
All right,
Yes.
Very cool. Well, I appreciate you having me, and thank you for reconnecting, Steve. It's been some time. So, all right, cool. So, yeah, the topic is vetting sponsors and syndications, basically from a limited partner perspective. I'm Travis, full-time passive investor and director of investor relations at Ashcroft. This particular presentation that I'm going to be sharing tonight is really what the purpose is not to come from the Ashcroft angle. We're not going to be talking about Ashcroft deals and stuff like that. I really just am passionate about teaching other people about passive syndications, the power that they have. And this is more the educational content around Steve and Jim's topic here. So some disclaimers here, not a general solicitation. We're not talking about, you should or you shouldn't invest in deals. We're not going to talk about any current deals on this call. It's just for informational purposes only. So seek your own legal advice. I'm not a tax advisor or an attorney. So a quick background, we already kind of covered it, but full-time passive investor, 30 plus syndications as a limited partner, director of investor relations. So my story is basically that I got started with single family investing in 2009. And at the time I had a W-2 job in the oil industry. I was working 98-hour work weeks away from home. And, what I was doing unknowingly was building myself a job with these single family homes. I really had ambitions to scale up to 50 single family homes, maybe even 100 one day. That was just sort of my initial goal setting. And without even getting 20% to that goal, I was burned out. I was completely done. I couldn't find a proper way to scale that business model. So I just went back to the drawing board and I switched over to passively investing. I did a lot of research on how people can be passive and what apartment syndications are, what syndications are in general. And so from 2015 through current, that's been my focus. That's what I do full time. And that's allowed me some free time to work with various syndicators to kind of learn the business models from the inside out. So a little over 10 years experience in real estate and a passion for just helping other people discover this asset class and this business model more specifically. So the agenda that I put together is basically 5 things: investing philosophy, knowing your criteria personally, top 10 questions to ask a sponsor, a GP, and red flags to look out for. And last, I'll share with you a couple real deals that I've invested in, one that was good, one that was bad. And on purpose, I didn't use the extremes. I didn't want to show you like the worst deal ever and the best thing I've ever seen. I tried to pick them kind of middle of the road, just to be realistic. And we can kind of go over what we discuss and how that pertains to those deals. Everything that I discuss on the call, I'm happy to share with anybody listening in. I'll give you all my contact info at the end. Feel free to take notes, but just know that if you don't want to take notes, I'll share it with you anyway. So save you some time. So let's kick it off. Investing philosophy. So the do's. This is all just from my experience, my network of experience, my mentors that are 10, 15, 20 years beyond where I'm at doing the same thing. They're full-time LPs. This is just a combination of data that, I agree with, they agree with, that I've put together in this presentation just for reference. So you want to seek long-term relationships with sponsors and syndicators. Believe it or not, there's a lot of syndicators out there that would be more than happy to make $1 off you today and could care less if you ever invest with them again. More fee-based structures, they might be a front-loaded type of fund where they're getting a large chunk up front, and then they could really care less after that. They've made their money. So you definitely want to stay away from that and seek actual individuals that you resonate with, that you get along with, that your personal philosophy aligns with. You want to seek conservative firms who notoriously under-promise and over-deliver. So that can be a bit obscure. The way that you find that out is by looking at a lot of different deals, and you're listening and you're trying to pick up for conservative words, phrasing, terms, and just how they speak about the deal. And their track record is going to basically, the proof is in the pudding, right? So that's the best way to check it out. I focus on cash flow versus appreciation. I always have. When I made a dedication that I was going to be living on cash flow and that was going to be the primary source of income, the way I view a syndication deal is the reason I do value add stabilized projects is because they're cash flowing out of the gate. They have a high occupancy. You can often see the 10-year, the 20-year track record of the property before you invest. And you can kind of see what happened in 2008, 2009. How did it hold up? I really like that about multifamily and syndication investing. And as far as the 5-year projections on, here's what we think the economy is going to be in 5 years, it's anybody's guess at the end of the day. It's the same as somebody telling you in 5 years, here's what the S&P is going to be. We just don't know. And so I put a lot less emphasis on that. I make sure they're being conservative with it. But at the end of the day, it's the ability for that project, particularly, to cash flow. That doesn't have to be your philosophy, but that's mine. And I wanted to share that because it's a common thing that comes up. At the end of the day, it's trust your gut. We all know that, but if you're getting a weird feeling talking to a syndicator or a sponsor, or just something's off, you can't quite pinpoint it, just don't do the deal. Don't do the deal, or get a lot more comfortable with the individual. And maybe you can overcome that by a face-to-face meeting or something and kind of figure out what's going on. But you certainly, sometimes we can pick up on things, subconsciously that you really can't identify or pinpoint. So that's critical. So as far as the don'ts, I wouldn't work with sponsors that are only good at marketing. I'll share with you a quick story. I was at a conference in Dallas, and conference is about to start. It's like 8:00 in the morning. We're all taking our seats. And I noticed there's this guy walking around handing out business cards to every single person without even talking to them and without hardly even looking at them. Just handing them out to as many people that'll take them. And he gets around to me and gives me the card. And it's an actual deal. Like, it's a 506c offering. So he's not breaking the law or doing anything wrong, but like, that's horrible. This is like the worst. He doesn't know anything about me. I may not be accredited. I may not even be an investor. It's just bad stuff. So, if you start getting like spammed by sponsors, or, seeing deals pop up and like every 2 days they're sending you a reminder, don't forget about our deal. Only a few slots left. You better hurry. It's going to close. It's so much marketing, but that's probably not that great of a deal if they can't fully subscribe it, just by sending it maybe 1 or 2 emails max. Don't work with groups that are aggressive in their assumptions. Again, the best way, is really just experience of looking at a lot of different deals. But, let's say a market's had a 5% rent growth in the last couple of years. What I've seen before is they'll take that data and say, well, we suspect it's going to be 5% for the next 10 years. And so that's going to be our underwriting assumption. But we know that's not going to be the case. There's going to be some kind of downturn, recession, softening of the market. You can't always rely on constant, consistent rent growth like that. So I like to look at, data statistics and then making sure that they're being more conservative than that. Don't work with groups that force the numbers. Oh my God. this one is prevalent, has become awful in the last 12 months. Just taking on way too much debt leverage. I've seen a lot of 80% loan to value deals. I've seen a lot of bridge loan financing, to try to, bridge the gaps there, so to speak, and just make the numbers look more presentable, when in reality, it's not a very conservative deal. It's a high risk deal, and you want to avoid that. Again, experience and looking at a bunch of deals will give you the best indicator. At the end of the day, it's just trust but verify. That's kind of the age old saying, but it's so true. If you're hearing this is a great neighborhood, it's a great submarket of whatever, Dallas and blah, blah, blah. I get on, for example, Google Maps, and I'll take a stroll around the neighborhood. If I can, I'll go out there in person. I always try to walk units before I invest, but I know that's not always practical for everyone. And, check out like the school ratings and stuff like that. I mean, it's, it might be a great submarket, but you really want to know for yourself in your mind that it's a great, strong area to invest in. So knowing your criteria is huge and critical. I talk about this all the time on podcasts that Steve was referring to. I think it's like 30 plus podcasts at this point. I don't even know. But knowing your criteria is critical. I did not know my criteria when I got started in 2009. I was just doing anything and everything. I was just doing a fix and flip, and then a buy and hold, and then house hacking, and then a vacation rental. And I had no rhyme or reason. It seemed like a good deal. It was undervalued. I'm buying it. And you don't want to do that. I wasted so much time and energy and effort trying to learn stuff that ultimately I wasn't going to end up doing anyway. So I know that's a long list. I'll skim it. This is my criteria. Again, it doesn't have to be your criteria, but this is an example of what I mean by knowing your criteria. I look for stabilized assets, meaning that they have a 90% plus occupancy upon takeover. I'm cash flow focused, as we described. I like light value add. I do like value add on everything I invest in, but I don't like these, it's 20% occupied today because it has catastrophic issues and we're going to try to take it up to 100. There's a lot more risk in that. I look for monthly distributions just because it's my income. If you're investing with an IRA or a trust, or you've got a 30-year time horizon, you may not care about that, but I look for monthly. I look for firms now with track record and a good reputation. I didn't value that in the beginning. I was way too deal focused, and I was looking at a lot of pro formas and just taking it for face value. That was a huge mistake. And I look for conservative underwriting. We've hit that one pretty good. Preferred returns, meaning the deal must have a preferred return, which means the limited partners are getting paid the first bit of capital and income that's coming off the property before the general partnership is taking their fees and their splits, their commissions. It's an alignment of interest, and it makes it more likely that you're going to be getting distributions. And I'll share with you a story in a few minutes where one of the deals didn't have a pref and kind of what happened. Low to average fees. Again, looking at a bunch of deals, you'll kind of get the picture. There's usually an acquisition fee, an asset management fee. There's a split upon the end. Sometimes there's a hurdle fee. Technical, but at the end of the day, you just want to be comfortable with the fee structure personally. Everybody's different on that. Long-term fixed rate debt. Okay, this one's kind of, a lot of people think of that as meaning like 20, 30-year long debt. That's not what I mean. I'm looking for structures that, let's say it's a 5-year hold. I want to make sure that there's at least 5 years of fixed rate debt, or if it's adjustable, that they've bought an interest rate cap, things like that. I do not like bridge loans and temporary financing situations, things like that. Because if liquidity dries up or you can't get or refinance, then you could be in big trouble at that point. So my general rule of thumb is at least the length of the business plan, if not longer, for the debt. Ideally, interest only for several years too. Tax and business friendly states. I like Florida. I like Texas. I mean, I've invested in a lot of different states, but I tend to shy away from like California, for example. A lot of reasons I don't like the investment landscape out there, but comes down to things like rent control and can you evict tenants and for what reasons? And I don't know if you guys caught this in the news lately, but Oakland, California, it's now illegal to run a criminal background check on your tenants. So seems kind of crazy to me. It's actually a criminal offense if you do it as a landlord. And I just can't even imagine not being able to do that. So
Wow.
you just, picking up on that stuff just kind of from a macro level, you don't have to be an expert in everything, but just understanding that stuff exists in certain states could prevent a lot of issues. Employment diversification, very important. Think about like Detroit, for example, right? In 08, 09, I mean, that was a tough market to be in, tough for multifamily, even though that's a heck of a sector in recessions. That, nothing can save, when you're relying on one or two employers in one sector. So I think the stat in Dallas, Fort Worth, for just to use that again as an example, is like there isn't any one employer that employment sector that makes up more than 20% of the overall job economy there. So if healthcare went down, you've got a whole bunch of other industries kind of lifting the tide, so to speak. 3 to 7 year holds is my criteria. I've invested with groups that have kind of these infinite return models where they don't really project a sale. You go in, you value add, you refinance out your equity when you can, and you might be in that deal for 10 or 20 years. I do some of that, not my favorite. I like having kind of a 5-year sweet spot so that if the landscape changes or my philosophy changes, I have that option every 5 years to redeploy into something different if I choose to do that. And direct ownership. I'm not a big fan of funds. I have invested in a few of them, and they're great for diversification. But what I don't like about funds is you're often in the syndication space anyway. You're having to deploy your money up front, let's say 50 or 100,000, and you don't exactly know what's going to be put in the fund upon day one. So what happens if property 3 or 4, you don't like it, or the debt structure is bad, or whatever? You're stuck. It's an illiquid investment and it's going in the fund anyway. You're basically being forced to invest in it. And I don't like that as a passive investor. So again, that's my criteria. I'm sure everybody's got their own and you'll agree and disagree with some of that, but just food for thought. All right, let's dive into top 10 questions to ask a sponsor. Again, combination of my experience with people in my network, my mentors, things like this. How do they handle key person risk? This rarely comes up from passive investors asking this question, but what if that general partner passed away? What if that general partnership breaks apart, due to a feud? How is that handled? And the important thing, there's not a right and a wrong answer on how to handle it. It's that they have thought about it and that there's a plan in place. You can buy key man insurance. You might, have an attorney or an underwriting guy or an acquisitions person step in on behalf of the GP to take over the syndication. It just depends. But just knowing that there's an answer can go a long way. It shows how much they've really thought this through. One of my favorite key metrics to look at on multifamily is the break-even occupancy. This can quickly tell you how conservative they're being and how good a deal is from a general perspective. It's just a one-stop shop. They should always know what that number is right offhand, the general partner should. And I always ask for like a sensitivity analysis or a stress test. And that's just usually a 1 or 2 pager, and it'll show you all the what if scenarios, as in what if interest rates go to 6%? What if our occupancy fell to 70%? What if? And it'll show you what impact that would have to you, the limited partner, on your cash flow and your IRR. Track record of either the company or the GPs. So this one gets a lot of debate. I don't have a problem with 2 highly experienced individuals coming together to start a new company and start doing deals, and somebody asking, how long's this company been around? 6 months. That doesn't necessarily mean it's a red flag. I just want to know the experience of either the company itself or the general partnership, that they know what they're doing. So does the sponsor do the same type of business plan consistently? This one to me is huge. Again, this can be your own criteria or opinion, but I try to seek out groups that do the same type of sector over and over and over and over again, because they become experts in that space. They've been around the block a time or two. They've ran into the issues and the hurdles that can pop up. There are so many groups out there that do a little bit of self-storage, a little bit of multifamily, a little bit of rentals, a little bit of, and the fact is you just can't be an expert at everything. You could try to compile this massive team that, with experts all over the place, and maybe it could work, but the odds are one deal is going to do well, the other's not, and the other's going to kind of be so-so. I mean, that's generally what I see in the industry. It's a must for me that the GPs are going to invest in their own deals. And sometimes you might be surprised that they'll say they are, but they're not going to give the number out because it's very low. It's like, yeah, we're investing in this deal. We're going to put $2,000 in. Well, that's nothing. I mean, they're going to pull a $100,000 fee, right off the beginning. Why are they putting $2,000 in it? Do they not believe in it? Are they not, financially equipped to do it? I mean, you just want to know what the answer is. So I always like that alignment of interest, that if the ship goes down, they're going down with it too. It's not put your money over there and then they're going to gamble with it and see what happens. We're continuing on. What is the projected cap rate upon sale? Again, I rarely see that people are asking this question. The point being, with cap rates, if it's going to be a conservative deal, they're going to project that the future cap rate is actually higher by either half a percentage point, sometimes a full percentage point. And what that tells you is they're projecting a softening of the economy. We hope it's not going to be the case. Ideally, cap rates just go down, 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 all the way to zero, because that means that the equity is going up, 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 and we're making a ton of money. But to be conservative, I like to see if they're buying at a 5 cap, they're selling at a 5.5. That's the projection anyway. I just hope it doesn't happen. But if you can make good numbers happen off that scenario, that's a good conservative approach. All right. So are the projected returns gross or net? This is another thing about making the numbers work that I see a lot, is they'll say, well, your average cash flow on this deal is going to be like 10%. Well, are they factoring in all of their fees and splits? Because at the end of the day, you might actually be, receiving a 6% return. And so I see a lot of these gross numbers being thrown around, especially the last year or so, and especially with newer groups, just trying to make their deal look as good as possible. So you just need to ask. Usually it says in the pro forma whether it is or it isn't, but just know the difference. Also know the difference between a preferred return and average cash flow returns, or cash on cash, because sometimes the pref may be 6, but then the average may be 10. So don't expect to be getting 10% cash flow, at least not in the beginning. What are their fees? Here's the thing with fees. You just need to be comfortable with the fees yourself. For example, I'm in a deal. It's not a multifamily deal. It's a syndication deal. And the sponsorship team is taking like 60% of all of the profits and leaving the limited partners with only 40%. But even with that factored in, it's still close to a 20% annualized return. So am I okay with those fees? Yes. But is that an extremely high fee to take? Yes. So it's just about you being comfortable with the end result, the IRR projection, the cash flow projection, if that works for you. Can they provide a prospectus or a company overview? Hugely important, hugely professional. If they can't even tell you what their track record is or show you any kind of data supporting that, or if the company's brand new, this could potentially be a red flag. Why wouldn't they want to share that? Are they hiding something? Do they have deals that went bad and they're just not wanting to display that? So ask for that every time. What type of debt structure are they using? We talked about debt structure. You just want to know, is it conservative? What's the interest rate? Is it interest only? For how long? Is it fixed rate? Is it adjustable? Do they have an interest rate cap? There's just various questions that go in there. Usually that's all covered in the pro forma, so you probably don't even need to ask that, but you should be aware of it. All right, moving to red flags. No PPM, which is the private placement memorandum. This 9 times out of 10, this is just a definite red flag. I wouldn't do the deal. Now, That being said, there's a few exceptions and reasons why there may not be a PPM, and it may be legal and it may be fine, but 9 times out of 10, that's not okay. They're either not aware that they need it, they're trying to save on legal costs, or it could be a fraudulent investment. So straight up, they have to have a PPM. No prospectus or company overview, we just talked about. Why not? Why wouldn't they want to show you that? No track record. One caveat to that: new groups I'm not opposed to investing with. I've certainly done it, but here's the caveat. If it's a new team without a track record or a new company, they have to either have, in my opinion, a mentor or a co-GP, someone that's going to be looking over their shoulder, approving the numbers, going over the deal structure with them, a consultant, someone that's going to be helping out with the deal. Typically, I will just not invest with a brand new group that doesn't have that at all. That's just, there's nothing to go by, so your risk goes pretty high up. No digital docs, kind of a funny one, but it's serious. If you're in the business of doing syndications and you're doing the old school, hey, why don't you go to your printer and print these 200 pages out and sign them and mail them to me and FedEx? It's just so ridiculous. And when you're working with self-directed custodians, and I'm speaking from working inside of a syndication firm in investor relations, this wasn't with Ashcroft, but when you start doing that kind of stuff, you'll learn your lesson once. You've got to go digital. So it could be a red flag that they're a new group or that they're trying to cost cut, which is crazy because it's not that expensive to have a DocuSign account or something like that. We talked about no GP co-investment. That's a big red flag. Why wouldn't they want to invest in their own deal? Buying into an existing LLC, typically you don't want to do that. So what I mean by that is if they're buying a property and they're not creating a brand new entity specifically for owning that property, they're just going to take whatever was there. You may not know what liability is lingering around on that pre-existing LLC. So if a lawsuit comes up that was from previous events before you purchased it, you're now the owner of that business. You're now responsible for it. So I'll share with you a story about a deal I did like that. Don't want to do that. And I keep getting back to gut check, but that's always a good red flag indicator. If something's off about something, just, either keep getting to know the person. Maybe you'll figure out what that is, or just simply don't work with them. Don't do the deal. It's a relationship business. You guys, you're going to be in these deals for, 5 years, 7 years, 10 years. You got to like the people you're working with. You got to trust them. And here's a couple deal examples just to wrap up. So I did a deal out in Atlanta. This was between 2016, 2019. The actual time frame was about 2 years. 454 units spread across 2 different properties. They bought a property portfolio. This was basically the front page of the project overview. I've marked out all their personal info just for their sake. 100,000 investment, 3 to 5 year hold, projecting 11.8% cash on cash returns. Says nothing about a preferred return, so take note of that. Basically 125% total return over 5 years. So theoretically you would double your money and then some over a 5-year time period. It's a stabilized property. It's got great, strong performing indicators here, basically is the takeaway. So 1980s built, light value add. There's a couple pictures of the units. And so here's what actually happened with that deal. I put 100,000 in. The first full year was 2017. They distributed $3,500. They had projected 11.8. Not good. Had a slow start. They had about 10,000 excuses as to why that happened. 2018, they distributed 0 for the year. They had projected 11.8. 2019, they just had to sell it. They didn't know what they were doing. They messed the property up pretty bad, and they couldn't execute the business plan due to lack of experience. And so, yes, it made some money. They sold it, thank God. Ended up with like 32 grand over a couple of years. Not so bad. I'm not complaining about the return, but what they had projected was 47,250. So, they missed the mark by 32%. What was more frustrating is I thought I was going into a deal that was going to last, 5 years potentially. And then 2 years later, without having distributions through most of that time, I got a lot less return and had to go find another deal, and ended up not working with this group again. So what happened? Well, here were some of the red flags that I should have caught, but it was kind of early on, and I had my reasons at the time for doing the deal regardless, but these are lessons learned. They had a 9-page project overview. Just to give you guys perspective, if you're not aware, an average project overview is probably between 40 and 75 pages in length. This one was 9. So why is it so short? What are they leaving out? Why? No webinar, no conference call for the project. This was just, hey, we've got an email list, so let's send it out to those folks, and word of mouth. Not good. No digital docs. This was the old school, printed at home and FedEx it to us. Crazy, inefficient. No preferred return. Didn't really give them the incentive to send the distributions when they weren't really obligated to do so. They had full discretion to just say, we're not going to distribute this year, or we're not going to do this quarter, or whatever. Having a preferred return is always a good thing, in my opinion. The GP had 10 years experience, so he said, but it was in single family. So that really was irrelevant. And the minimum 100K, well, I put in 100, but I later learned through other investors in this deal, I could have put as little as 25K in there. So it was a mere recommendation that I put 100. And that's something I always advise people. If you're not feeling like the deal is amazing, then maybe, or it's a new group you're working with, maybe you try to put in 25 or maybe 50 or something. You try to get them to lessen the minimum if possible, to get involved and to start learning who they are. And man, I wish I would have done that on this deal in particular. And they bought an existing LLC, which did have some liability that they weren't aware of. So they had to fight some frivolous lawsuit stuff that came with the deal, which is why the returns were what they were in year one. And one of the partners swindled some money. He happened to be the owner of the property management company, of course, that they use on the project. And so he started doing some shady business. They kicked them out. And as that was under investigation, that's why the second year we had 0 in distributions, because we didn't even know what numbers were real and what numbers were fake. And so that's what amounted to that. So those are the lessons learned. A good deal that I did, not the best, but a good one, was in Phoenix, 2017, 2018, occurred just after this. 186 unit value add. There's a couple of images of the property, just pretty basic, 1980s, I believe. Put 100 into this deal. 2017, they distributed more than what they projected. That's the under promise, over deliver. 2018, they had substantial distributions, but that was because of a sale. All in all, 20,300 distributed. They had actually, if you prorate the business plan, it was about 13,750 during this time frame. So a substantial increase from what they projected. Now, I share this with you because it wasn't a perfect deal, but they made some really good decisions. They got a good offer. They executed that offer early. It was kind of that decision of, do we wait several more years collecting a small cash flow amount, or do we just take a substantial gain right now? And that was just a better decision all in all. So this project had an overview that was 38 pages long. There was a webinar, there was a conference call, there were digital docs, there was a preferred return. And what they did is they hired someone with 20 years experience as a consultant to help them execute this deal. This was a sponsor that was not brand new, but I wouldn't exactly say they had a track record either. But they were able to overcome that hurdle by hiring on the experience, and it really paid off by finding that offer that came to them. And that was multifamily experience, by the way. They created a new LLC when they bought this deal, and they had conservative underwriting. It was a 6-person full-time staff. I see a lot of syndicators that are one-man, one-woman shows. That scares me. I like having multiple layers, investor relations, acquisitions, underwriting, things like that. So we're getting to the end here. Order of importance. This is my take. Lessons learned, simplified. I vet the sponsorship team as number one. I say that's the most important thing, in my opinion, to vet out before making an investment. Number two is the market. You could tell with that first deal I showed you that, thank God, they bought in the right market at the right time at a good price, and it bailed us out because the sponsorship team got a 0 on that. But we ended up being profitable. That was because of the market. The last thing is the deal itself. If you put these in order and you have an experienced team that knows what they're doing, they're investing in a great diversified market that's growing, they're likely going to be doing a good deal. So you still vet the deal. Obviously, it's just not as important. I used to reverse these, by the way, when I first got started, and those are the lessons learned. So happy to share this presentation, these notes, happy to do a Q&A call. I prefer to do Q&A calls, by the way, one-on-one instead of the open-ended Q&A. I do 15-minute free consults for anybody, anytime. Best way to reach me is travis@ashcroftcapital.com. I will reply same day or early next day. And from there, I'll give you a calendar link, any uploads, any resources that may help you. We can talk about your situation and your goals, and whether that's an Ashcroft thing or whether that's any other group out there. I'm happy to kind of give you any resources that'll help. I'm on Instagram. I'm on Facebook. There's the links to those. And please do reach out. My mission really is just to be a resource. It's not to sell anybody anything. I don't have any programs. I don't have any books, anything like that. So I'm just here to share experience with you guys and make it applicable to your situation. So with that, I'm pretty much finished. So I thank you, Jim. Thank you, Steve. Thank you, everybody, for being on the call. And was there anything else I could help answer before I drop off here?
Yeah, do you mind answering a couple of questions?
We can do it real quick, but I do have to go. So yeah.
Okay,
Questions.
Yeah, I just wanted to ask, how do you find new sponsors? I listen to a ton of podcasts, and that's usually my source. But I know a lot of them are doing podcasts to find people, and that's fine. You still need to vet them. But how do you find new ones?
Yeah, that's a great question. Depends on you, really. So what I do is I started getting really engaged and involved with groups like you guys are in right here. I started joining local real estate meetups, bigger pockets, attending big conferences, attending smaller conferences. And through all of that, it's a relationship business. You inevitably run into a lot of folks investing in the same deals that you're investing in, and new ones, which is a great opportunity to pick people's brains. Leverage people like myself, doesn't have to be me, but people that are heavily involved in the industry, and pick their brain about different sponsorship groups and what their experience has been. And then, like you said, podcasts are great, stuff like that. But a lot of these syndicators are operating under 506B offerings, B as in boy, which means that they can't generally solicit their deals. They can generally solicit their company by saying, hey, we're a syndication firm. We do multifamily, so connect with us. So it makes it a little bit tricky. You have to get on a lot of people's deal lists and Google search a lot, and find references through that. So it's kind of up to you. I like in-person stuff, but Bigger Pockets has helped me tremendously too. I'll throw a sponsorship name out there, who's invested with Ashcroft Capital, for example, and you'll get 100 different people chiming in. So that's a good way too.
Okay, awesome. Does anybody else have any questions before we let Travis go?
Really appreciate you jumping on and sharing with us. This was great.
You bet. Hopefully you guys found some value in that. And I know we only had a limited amount of time. So what I really like to do, honestly, is just hop on a one-on-one call. I like to find out what your goals and objectives are, what your experience has been, and then see how I can help. And it doesn't have to be an Ashcroft thing. I mean, my purpose is really just to help educate and say, here's a great book, here's a great site, here's a great blog or great podcast, whatever it may be. So definitely reach out, and thanks again, you guys, for having me.
Great. Thank you.
Thanks, Travis.
Thanks, Travis.
If everyone else wants to hang on here, we can, there's a couple other things we can get to on the agenda, but I think, does anybody have any questions or comments or thoughts about Travis and his presentation?
I'll just say that was amazing for just for me. That was like everything I wanted. And as he was going, I was like, I hope he talks about this. I hope he does this next. And then he did it. It was like the best 30-minute presentation. So yeah, it was really good for me. I benefited.
Good.
Yeah, I really appreciate you guys coordinating to come talk to our little group. I think that's pretty awesome to get that kind of knowledge from somebody. So thank you for putting that together, Steve, Jim.
Yeah, no, that was Steve. Thank you, Steve. That was awesome. I agree.
Yeah, when I talked to him several weeks ago, I just happened to throw that question out. And he said, "Oh yeah, sure, I'd be happy to do that." So I'm glad he was on there. I mean, I learned a ton too. I mean, I've been doing this for a while, but there are some different things I'm going to be asking more for and information. So I thought that was really interesting.
Yeah, I think the one thing that left me curious at the end is he wasn't real into answering questions. He wants to do a one-on-one call, and I'm wondering what that entails if he does coaching or something, which is fine if he does. But I'm curious because I did talk to him when I was wanting to invest with Ashcroft, and that was all about Ashcroft. You know, I was vetting the sponsor, but I think I'm going to jump on with a call and see what his 15-minute free thing is, and then see what comes after it. Because when someone says, I'll talk to you for 15 minutes free, I'm expecting then after 15 minutes, he's going to charge me something. Do you know anything about that, Steve? I'm fine to pay something if I get value because he knows what he's talking about.
I think I spoke to him more than 15 minutes, so I don't know. I mean, I wasn't asking specific questions. I was just trying to learn more about Ashcroft, but yeah, I don't know. I'm not really sure. Did anyone else talk to him, Ashcroft?
I did. I didn't talk to him, but I talked to somebody else on their team. The one thing that I thought was interesting on the call, not with him today, but on the call, was it looks like Ashcroft, they require more investment for your first investment than other syndicators do. I forget the numbers. I think they require 50 or 75,000 up front at first, and then your second and beyond you can. Where some other syndicators, I think they're at the 25 or they don't have such a high initial investment cost.
Yeah, actually, that is true in general. But on the one deal that Ashcroft has out now that I know of, they are accepting a lower 25,000, and I think it's because of they might be having a problem getting capital, or people don't want to cut as big a checks with what's going on. So you can jump in with Ashcroft now for 25 grand on the Woodland Key deal.
Okay, that's good. Good.
Yeah. Anything else on Travis or Ashcroft? Anyone besides me going to schedule a call with him?
I'm curious too. I thought that was great. I think it'd be really interesting to learn some more from him.
Yeah, well, I definitely will. And then Chad and Joe, if you guys do, I think that's something we can maybe add to the agenda for next time, just to review calls with. Let's make a note. Review calls with him. All right.
Yeah, Jim, I just fired off an email to him. Hopefully I'll get something scheduled with him as well, because I want to talk to him about that Woodland Key.
Okay, perfect.
One thing I did finally understood is because of this presentation was on the overviews, you'll see their entry cap rate, and then there'll be an exit or what's called a reversion cap rate. And sometimes they'll have a range. It may be, the same, or maybe 0.5 above, or maybe 1% above. But I didn't really quite catch exactly why that was important. And then when he explained that it has to be at least 0.5% increase, because that's a conservative amount versus lowering it, that finally made sense to me. I just never really thought about it in that way. So that was good for me.
Anybody else have anything on Travis? All right. Well, I don't want to make this meeting go too long, but we did have an agenda of things that we could talk about past this. And are you guys up for listening to Tom? Are you okay to talk about life settlements?
Yeah, I'm good. Sure. I'll share what I know for sure.
Yeah. Okay. So we'll turn it over to Tom, and he'll let us know who he talked to and what he learned.
Okay, very good. Well, definitely not the end-all, be-all authoritative source on life settlements, but I can at least share with you what I learned. So I ended up 3 different interactions that I had on life settlements. One, Buck Joffrey had one of his podcasts. I think it was podcast 203 if you want to check it out. But it was all on life settlements. So that intrigued me, based on what was discussed there. And the next week, Buck had an investor call where there was a little bit more interaction, asking questions and getting a little bit more in the details. I was on that as well and continued to intrigue me. And then I actually did a follow-up and had a one-on-one call with one of the guys with ASR Alternative Investments. And they essentially are a sponsor who helped to kind of orchestrate some of these things. And they're actually working with Buck and his group to create an offering essentially for Buck's group with a number of these life settlements. But maybe what I can do is just talk a little bit about what a life settlement is, and then how you can invest in life settlements, and then also kind of where I'm at, and maybe touch on those few things here. So a life settlement, kind of in Tom's words, is essentially a cashing in of a life insurance policy by some older policyholders, obviously prior to their death, and it's for a number of reasons as I'm learning. It could be that they're looking to get some kind of cash. They have some kind of a need later in life. As all of us, or most of us who get life insurance, is for reasons to make sure that your family is secure and can operate financially in the event something happens to you. But a lot of times, all those life events passed, and kids grow up and they're no longer, in the house, and they're out of college and they're doing their own thing. And so all those reasons why you would typically have a life insurance policy, at least maybe a higher level one, would those life events would, pretty much come and go. So as you get later in life, what I've learned is there's a couple different ways you can actually get one is, if you have a life insurance other than term, sometimes they offer a cash value. So, somebody who has a policy could go after the cash value. Typically, it's a lot smaller than the premiums that you'd put in. And the other option essentially is selling these life insurances policies essentially to investors. And that's essentially how you can, get involved in investing in these life settlements. But so that's kind of in a nutshell in Tom's version of what is a life settlement. But the way you invest it, essentially, it's with these with the sponsors, ASR Alternative Investments, they they'll pull together. Think of it as, I don't know, maybe in my words, kind of a mutual fund. Think of it as a pooling of a number of insurance policies where investors come in and they contribute to this fund. And the way that that ASR works is they'll have one offering each year, and based on the number of investors and number of actually folks that get into the fund, they'll then whatever the total amount of the fund would be. But essentially what they do is and that what we
Tom, are you there? Is he breaking up?
Yeah.
Yeah,
Can't hear you,
he's
Tom.
gone.
It's gone max headroom on us.
Yeah. All right, well, we'll wait for him maybe to bounce back in here. Is anybody else looking into this? Because I had the same conversations with the same guys, and just to add a little bit to it is, if you're not familiar with this, what they do is they probably buy like 10 policies in a fund, and they find these guys who are in their 80s. Usually they're older, that have maybe a $5 million death benefit, and they still owe premiums on the policy that have to be paid every year. So the fund pays the premiums, and it's kind of morbid, but they just kind of wait for the guys to die. And when they die, that's then you get your capital returned. And so they, right now, they're in between funds. They're starting up a new one. So if you invest now, my understanding is you can get into the last year's fund and next year's fund. And, the sooner you get in it, the sooner it, rewards you, I guess. Tom, are you back?
Guys, can you hear me okay?
Yeah.
Okay. Yeah, I don't know what happened. Sorry about that. But anyway, I forget where I left off, or I left you guys. I heard you a little bit, Jim, talk a little bit about, right when I was coming back, a little bit about what they're doing. But so where I'm at is I've done a little bit of research, and I actually was still intrigued, but what I did is the last call that I had, let me find my notes here. The last call I had, so they of course sent over a PPM, a private placement memorandum, with all the details, which is something similar to what we just heard from Travis. But what I asked for, though, I said, well, send me over a PPM from a prior deal. And they did, and inside that PPM, they actually have a section that talks about experience of the sponsor. And I dug a little bit further into the experience of the sponsor. So this is ASR, Alternative Investments. And what I found was very interesting and actually a little concerning. So I don't know, Jim, if you've done any more research on this, but here's what I found is, so if you go back 8 years, and again, they do these annually, if you go back 8 years, they've raised $74 or $75 million. But in those 8 years, they have only distributed about $6.5 million out. And from what I heard on some of these calls was that typically you expect like a 3 to 7 year return window, because the what they call it, the focus or the age group of what they look for in some of these policies is somebody who's 85-ish with about 5 years or so of life expectancy left. Usually a 3 to 7 year window rather of an investment time frame. But anyway, so looking at what they raised and what they distributed over the last 8 years, they've only distributed 9% of what they've raised. So and that's kind of where I am. I'm maybe a little bit more cautious now on whether or not I get into this. But Jim, I don't know what have you discovered, or what kind of research have you seen?
I didn't dig into it that deep. But I think that's not, that is surprising, but it's not completely surprising. They really underwrite these things on the individual policy level. They take, and you can see every policy in last year's fund, and it says the age of the person, their gender, what ailments they may or may not have, and they have 2 different firms that give an estimate of life expectancy. And from what I understand, that life expectancy is kind of like the average of what you would expect. So they're usually, as you said, in the five-year range maybe. So you would expect a few to go earlier, and then you would expect a few to go later. But these people, they could live to be 100. So I think it's very volatile in that, or not volatile, but just unpredictable. So that's something to ask for sure. The sponsor, like, why is that? And I'd be interested in what their answer would be, but I don't know that that's disqualifying. The returns on this are, they promise, or it's not a preferred return, but they talk about an 8% expected return, but it all depends on, how quickly these people, pass away. And, again, not to be morbid, but that's what we're talking about here is in the current situation, you think your results would be a little bit better with, unfortunately, with the COVID situation. That makes this investment seem better. Sorry to say that, but that's just, as an investor, that's what you're looking at. Unfortunately, that's how it is. So I haven't decided whether I'm going to do this or not. I've decided that if I do it, I'm going to do it with my qualified retirement money, because I don't want to really put my current money in this. So I'm still thinking about it. Their minimums are flexible. I think their minimum is 75 or 100, but they said, Buck, he just thought, well, whatever you got, we can put in there, because I told him I was kind of moving stuff around. So I think they're pretty flexible on that. I think if you're thinking about doing it, now is a great time, because from what I understand, you'd be in last year's fund and next year's fund. So you've already got the clock ticking on the ones they bought last year. And these things will pay out. I mean, it's guaranteed. It's just a matter of when, because no one lasts forever. And they also underwrite the insurance company to make sure they're in qualified or they're quality insurance companies. So it's a morbid investment, but it's a guaranteed payout. Just the IRR is going to depend on when you're paid, right? You know you're going to get paid. It's just a matter of when.
Hey, I was just going to add, I've got limited experience with life settlements, but only from a certain, from the other side, really. So clients who have life insurance policies, and we've looked at doing life settlements for them so that they could cash out. And I was just going to point out, I think, Tom, you said it, but or maybe it was you, Jim, but one is the death benefit, but you can also, like, there's nothing to stop anyone on this call. You know, you see the signs, maybe some of you have put them out there, like, we buy houses for cash. There's nothing to stop you from putting we buy life insurance policies for cash on a yard sign and putting it in a yard. You and Jim Pfeiffer could do a deal where you buy him out on his life insurance policy. Why would you do that? Well, there are people that that need cash. It's the same reason that you buy that investment property. It's the person, for whatever reason, really needs cash, and what they have is an illiquid asset, like a house. So it is morbid, but it's also, you know, it's like you could really be helping somebody out doing a deal like that. I've also met people who just wanted, you know, maybe it was cash flow or something like that. But if you could go into a life settlement deal just for the cash and not for the death benefit. In other words, just a straight life insurance policy takes years to start building up cash and get someone a good return. Some people kind of give up or just get tired of it. They want to invest elsewhere or whatever. I personally, I guess professionally, I'm not allowed to do certain things that we're talking about because of my background. But I've even known people getting rid of policies that I thought, man, if I wasn't licensed, I might just buy them out. In other words, they're going to cash out and take some cash with them. I could offer them maybe just 10% above their cash. And then I get a policy that went through all the low returning years. And now I have guaranteed returns going forward that are, you know, quite a bit higher because those early years are cut off the policy. Now, if they die, sorry to say, that's a bonus. Now you really get a good return. But no, you can do it just for the cash benefit of it too. So
yeah, that's a good point. I think the one risk, I guess, that we're kind of skipping over is on some of these policies, the premiums still need to be paid. And so if they last, 20 years, you're paying 20 years of premiums, you still get the death benefit. You'll still win. You'll still make money, but the longer they go, the less return you get. So Tom, have you decided, are you going to go for it, or are you still thinking about it?
I'm still thinking about it. I want to follow back up with ASR and ask some questions about some of these distributions that I found, just to better understand some of those numbers.
Okay.
So I'm still on the fence.
All right. Well, let us know once you get those answers. If that's before our next get together, either send out a quick email or just share it with us on the next get together, because I would like to hear what those answers were.
Hey, Tom, I had a question.
Sure.
Are there distributions? It sounds morbid again. After someone dies, is that what happens?
Yeah, actually, it's so let's say you have 10 or 12 policies in the fund. Once one of the policies matures, that's kind of the term for someone expiring, then that's when a distribution is made. So it's not held up until the end of the 5 or 7 years that Jim and I were talking about. It's just as it happens.
And so the fund would end after the last person dies then, right?
The fund would end after the last person dies.
Okay.
The other thought too, or at least where I read somewhere in one of the documents, was there's a 10-year time frame. Then after the 10 years, if not everybody has died by then one of the options is actually to then sell that then to the open market. So going back to Jim's comment of premiums still need to be paid. So if there's still that forecast of, well, 2 people haven't haven't died yet, and there's still premiums to be paid, and your return is coming down to, you know, very small numbers, then, you know, another option might be to just sell that then to the open market.
Cool. Any other questions for Tom? All right, cool. Thank you, Tom. It's after 9, so I think Mike will let you off the hook for this time, and catch you next time. Has anybody, before we close up, has anybody talked to any additional sponsors since our last meeting? No? All right, well, I think we'll shoot for 2 weeks, and I'll send out an email to kind of get an idea for dates. But I challenge everybody to try to get one call in with a new sponsor in the next 2 weeks. Now, we won't all talk about it, and, you know, I'm not going to go around the room and, you know, grade you on this, but just to get some more perspective and some more people talking. And eventually we're going to have the a spreadsheet that we can fill out, and then we can all look at it and kind of share information. So, yeah, that's all I got for tonight. Anybody else have anything they want to say before we sign off?
I did want to say, oh, sorry. So yeah, I did want to say the one apartment deal I have with Matt Pacini at MJP Properties. I know you know this, Jim, and I think Mike too. But he's actually going to be putting it on the market after 2 years. He thinks he can actually get the 5-year price now because it's performing so well. So I'll keep you guys posted with that. I think it's going to go on the market at the end of this month. So
Awesome.
This will be my first full cycle deal if it sells.
Great.
That's
awesome.
great.
Anybody else?
Everybody have a chance to log into Slack?
Oh, yeah.
Oh, no,
Check that out if you can.
I'm open
Mike,
to feedback, whatever everyone wants. I mean, it seems like a decent forum for us. It's free, so.
yeah,
I uploaded some stuff to it for from the previous emails, all the things I already put on there. I think you did too, Mike. So
Awesome.
Yeah, I think it's going to take a little bit of getting used to if you haven't used Slack, which I have not. But I mean, you can post anything up there, and I think it's good. I think it's a really good resource. Easier than sending emails and stuff. Like when I get the stuff from Travis today, I'll post that in there, or whoever gets it first, just post that up there, so we all can share it. I think it's a great thing to try out. So if you haven't logged in, maybe before our next meeting, at least log in and look around. I kind of put it off, but then once I did it, I kind of got stuck in there trying to see what I could upload and add. So it's pretty cool. So check that out, and thank you, Mike, for organizing it. Anybody else? Chad,
Hey,
you're
Chad,
muted.
Chad, you're muted if you're talking.
That's why I wore the bright yellow, so you could at least see me. No, I was going to ask you if you got an invite to Damien Lupo's meeting Thursday night for a new fund that he's starting up. I don't know if you heard about that I'm going to listen into and thought I could feedback. It's a joint venture they're a new group called Virtuvian Ventures, and they're calling it an M&M Opportunity Fund that's going to be focused on precious metals and mini storage. Very interesting, diverse kind of asset classes to look at, but I'm going to join that Thursday night. I can give that feedback next week or next time we talk, whatever.
Yeah, that'd be awesome. I have that on my list of listening in also, but I usually just do the recording on those so I can listen to it at double time. But yeah, I'll put that on the agenda for next time, Chad. We'd love to have your perspective on it.
Sure.
Anybody here invest in gold or silver?
I do. I bought into gold recently, and it's been doing great, obviously. So yeah, and the last couple of years, I bought some physical stuff too, just in case there's an apocalypse.
Yeah.
Here we
I've
are.
got some gold too, Steve.
Oh, do you? Okay. Yeah, I had silver several years ago, and it kind of went down, so I ended up selling it. But I think I bought some investment property with it. But anyway, yeah, I mean, it's probably not a bad idea as a hedge, you know, since the government's printing so much money out there.
Yeah. Well, silver's at historic lows when compared to gold. I actually bought some silver ETFs today, I think, right, Jameson? Yes?
Tomorrow morning.
Tomorrow morning.
It was 5 o'clock when we were talking. So
Oh, All right. Well, tomorrow morning I'm buying some silver ETF because it has not gone anywhere. And with gold going, it's at some point it's gotta go. So yeah, I'm stocking up a little bit at least. All right. Well, if there's nothing else, we will shoot for 2 weeks, and like I said, I'll send something out. And thank you all very much, and thank you, Steve, for getting us Travis. That was awesome. I really enjoyed that. And for the rest of you, we'll see you on Slack.
Thanks, guys.
Sounds good.
All
Bye,
right.
gang.
Guys.
Thanks, guys.
Thanks,
You guys
guys.
later.
Thanks
See ya.
very much.
Thanks, gentlemen.
Where's the thing at? Oh, well, you guys are still on. Can you hear me?
Yeah. Yeah.
You guys were talking about the woodlands. I didn't really delve into that much. I mean, Jim and I were having some email exchanges on the woodlands. The initial offering was different. I don't know if you saw that, Sean, from about a month ago.
Oh, I didn't see it a month ago. No, I just saw the
Yeah,
revision.
they kind of re-upped it. I don't know what happened. They probably didn't get it funded and COVID hit. So my thing was, one of the things I noticed was the cap rate was 4.7 and their interest only loan was 4.2. And that's a really small gap in my opinion. Then the other thing I just noticed was, well, now I'm sorry, now that's changed. Their the interest only rate is now down to 3.2. So that's like a 1.5% spread. So I think that's more reasonable. The other thing I was telling Jim, and you kind of commented on the email, Jim, was they're renovating. It sounds like, and I don't know the Ashcroft philosophy, but it sounds like they're renovating. They're going to renovate 100% of the units. And to me, that sounds great if you're going to buy and hold. The problem might come on the back end when you sell it. If you sell it too soon, and I use the term, if you don't leave any meat on the bone, meaning if you're renovating every single unit, you're putting washers and dryers in every single unit, you're giving them new kitchen countertops. In 5 years, there's nothing to add. So you're selling it to either a REIT or you're selling it to a someone who's a little bit inexperienced, and now that's just kind of maybe a cash flowing asset. So they're not going to be able to add value. You can only upgrade the landscaping so much. You can only upgrade the paint so much. I mean, that's not going to raise the rents. So they're not going to be able to. The next person's not going to be able to raise the rent. Brad Sumrock's philosophy is you always want to leave a little bit of meat on the bone, and that's so all his students will do that pretty much. And the one that's my apartment complex that's to be selling here, he's renovated 60% of the units, and I think that's kind of his goal. So and he's been able to raise rents, and it's been performing well. And so the next person who comes in will be able to renovate the next 40%, and they'll be able to raise rents. Their NOI is going to go up, and so it's going to be a win-win right there. So that's my only concern about this property. And again, I'm not in the market to buy anything anyway, so those are just my thoughts.
Yeah, it's interesting because I picked up on listening to you say that. I had a question that I was going to ask him, but obviously he was,
Mm-hmm.
trying to get off to dinner, and I sent him an email anyway. So I'll ask him tomorrow because on his checklist, one of the things that he looks for is light value add. And so that was what hit me in my head was, does that mean going in and having to do a little bit to everything, or just do a little bit to some of it and leave some meat on the bone? So I'll ask him tomorrow, or
I
whenever.
thought it said something about washer and dryers, but maybe I didn't. Again, I didn't really delve into it that much. But
I just looked at my notes, and their exit on these is institutional buyers. So they're not looking to sell it to another syndication who's going to do all the upgrades and needs meat on the bone. Their goal is to sell it to a REIT, I think. And the REIT, from my understanding, just wants everything done, and they don't want to do anything to it. So they want an A-class, basically, property that's all renovated and just is cash flowing.
And that, again, it all depends on the equation. So that makes perfect sense then.
Yeah.
So Steve, do you have anything else invested at this time with Ashcroft, or no?
No, I've got zero with them. I just kind of learned about them recently, just 2 months ago, I think. Yeah. So because I thought Joe Fairless was on his own still, and I didn't realize he teamed up with some financial guy in New York City. So he's kind of the marketing guy now, and so they're acquiring deals. But And it sounds like a solid company. If their track record is accurate, it's their returns are around 30%, I think. So it sounds like they're doing pretty well.
Yeah.
Yeah, I was going to ask you guys if you had any recommendations on areas I can go research that would include non-accredited investors, since I don't have my accreditation, obviously, that trying to find other areas, knowing there's some people in our group that are in that same boat as well. I don't know if you guys had any advice, any tips, places to look. Jim, you were kind of asking Travis that as well, that I wrote down some ideas, but I don't know if you guys have any spots for me to start digging in.
Well, we're working on a spreadsheet, or I am, and Steve's been helping me. And there are some. I know that Dan Hanford from PassiveInvesting.com, he takes non-accredited. So you just kind of got to call him up and find out. There's,
Right.
What was the other one? Oh, Michael Blanc with Nighthawk Equity. Matt Piceni, he takes them with MJP.
Okay.
And then, there's the triple net lease deal that Sean and I just did with MAD Capital. It's not multifamily homes, it's industrial stuff. They take non-accredited. That's all I found so far. But at some point when I can get around to it, I'll share this list. And my goal is we can have everybody add to it and just keep building it out. But I'd like to get the list filled out so people can see, because some of them accept non-accredited. You just gotta say the same way you're looking for anything. You just look, and then, that's an easy one, right? You call them up, say, do you take non-accredited? And if they say no, you're like, okay, next.
It's a quick call at least. No, that's good. That's good.
And Chad, I think in that link that I mentioned on our last call that Steve forwarded, that Intelligent Investor Real Estate Conference, I think there was a panel that discussed that. I didn't listen to it because it wasn't applicable to me, but I seem to recall that being a header on one of the talks, but
okay.
I might be getting it confused with something else. But I scan that list. There might be something there on that.
Okay. I joined that because I think it was about up when we met. So I'll go back and sift through those headlines or those titles.
Jim, it might be good to have maybe an email contact on that spreadsheet. That way people can just email the point person.
Yeah, that's a good idea.
That would make it easy for you, Chad, to just go down the list and email just one question, say, do you take non-accredited investors?
Yeah.
Right.
Filters it down a little bit at least.
And you can also, most of them have websites, and a lot of them will say on the website, or even when you try to book a call with them, a lot of them will say, are you accredited? They won't vet you, but they'll at least ask that.
Yeah, that's what Ashcroft had on there, is that they're only taking accredited investors right now for their new investment.
And now as you're getting into it, you might want to take a few of these calls, even with the accredited guys, just to practice the calls. And for when you become accredited, you'll at least know some other people, and networking.
It's a relationship business, so
yeah,
to start those relationships now. That's a good point.
Yeah, okay. And also if they only take accredited, they are allowed to take up to, I think, 35 non-accredited, depending on which regulation they're using, and that's completely up to them. So if you go through the call and they say, we're accredited, and you guys hit it off, and you say, well, can I just call you again, and you build up a relationship, they might take you anyway.
That's a good point. I think that's like discretionary, more or less, right?
A lot of them don't, because it's a hassle. It's just a hassle. So it depends on which SEC rule they're using. I don't know exactly, but you can get around it. You just gotta work a little harder, I think.
Yeah. Okay.
What I find funny on the Ashcroft PPMs is the example is, if you invested $1 million with us, this is what your returns are going to be. Who's going to invest that much money?
Yeah, exactly.
Yeah. Hey, Steve, I did run Sunrise through that Michael Blanc's analysis work. I don't know that it does show us a great view from a LP version of what kind of returns you're going to get and so forth.
Okay.
I need to go back and I needed to walk away from it for a little while and then go back and go through it all again. But I would say their numbers trued up to what were showing up in his calculator too. It seemed tried to align to their figures anyway.
Mm-hmm.
I don't know that it translated around kind of like what we were talking about, if it'd be a good calculator for this group.
Right. Yeah. It's a bit complex. I mean, there's like 12 different tabs and, but you do have to plug in the numbers. Someone has to plug in the numbers. So, but it would be nice to have a passive investor calculator like that.
Exactly.
I mean, that would be great.
There's your business idea.
Yeah, right.
Passive investment calculator. But I'll let you know after I go back through it. I'll share it with you guys, or can share it with the group or whatever.
All right.
Okay.
I bought into Michael Blanc's education. I can't remember what he calls it now, but with it, he's got this massive calculator for looking over deals to become a sponsor on. That we were kind of playing with it to see if it would help us from a passive investment standpoint too.
Mm-hmm. Yeah, you can buy the Excel spreadsheet for, I think it's $129, which I did about 2 years ago. So
I bought it for $2,000.
I don't get the education. I get like 6 videos.
Cool.
All right.
I appreciate the extra stuff. Sorry to keep you guys on. Too.
No worries. I'm just going to say to whoever's watching, if anyone made it to the end of the recording, this was an unplanned little bonus episode. So I'm going to stop the recording now. I'll catch you guys later.
All right. Take care.
Yeah. Thanks, guys. See you.
Thanks.